Chris Grisanti, Chief Equity Strategist at MAI Capital Management. Also, Robert Teeter, Managing Director and the Head of Investment Policy and Strategy at Silvercrest Asset Management as well. Gentlemen, thank you very much. Chris, we'll begin with you. What is it about today's jobs report that sticks out the most in your mind, and does it change your investment thesis?
Sure, Dom, thanks. It's nice to be with you again. I'd say two things are important about this jobs report. It shows that the consensus idea that there will certainly be large growth ahead and will last for a long time might be flawed in two ways. First, it may be less reliable. And second, it probably won't last for years. We're going to get great growth this year, and it will probably slack off next year. So that has consequences for stocks that you pick in the marketplace.
Now, Robert, I mean, if you take a look at the focus for many traders and investors on the heels of this jobs report, it is squarely fixed on hospitality and leisure. We know that the market's been seeing it for a while. Has anything changed about your outlook for those certain cyclical parts of the economy, given that we've seen this jobs report come out today?
No, I don't think anything's changed. You're absolutely right. That's the biggest disrupted part of the job market. About a third of the missing jobs are in leisure and hospitality. That tends to be a lower wage area of the economy, so it doesn't have quite as much impact on spend. It will take some time to get back to normal there, but by and large, markets tend to like things that last for a while, that you have a visible horizon, and avoiding a bit of a boom and bust. So I think overall, the market's digesting this. I think the jobs growth is on track, and we'll continue to see a pretty strong recovery.
What do you think, Robert, is the thing that could derail this recovery? All the news has been good up until now. GDP, survey data, sentiment data. This has been the first real hiccup. So what is it that we have to worry about heading into June, July, and August?
That's right. Well, over the summer, I think there's going to be quite a clash between the mindset of is inflation coming back versus productivity. Typically things heat up in the summer. We're seeing that a bit now with commodities. We've got a bit of supply chain and logistical demand issues that are sorting themselves out post-COVID. Don't forget the base effect issues and the pent-up demand. So I do think we'll see an inflationary burst here. But similarly to the 1990s, when there was a lot of tech spend, and tech spend really helps bring down inflation, I think we'll see that same dynamic here. The 90s started off with CPI over 5 and ended with CPI around 1.5, largely due to that tech spend. And I think we'll see the same thing happening here as we work through the summer and the fall.
So, Chris, I mean, you're a portfolio manager. That means you have to put assets into an investment vehicle for clients. Sure. What exactly does look attractive now at this point, with certain parts of the market at record highs and other ones still just lagging?
Sure, Dom. So I tend to agree with Bob that I think that the unemployment report is kind of a blip. But I also think 6 to 9 months from now, we'll be peering into 2022 with hard compares for these cyclical companies. And meanwhile, right now, tech and communications have been left behind this year. And they're growing astoundingly, not in a cyclical way, but in a secular way, which I really like. So, yeah, these travel and banking stocks and energy stocks will bounce back sharply this year. But where will we be in 3 to 5 years? And if you're building a long-term portfolio, I think some of these companies have really long tails, and they continue to grow, not at the expense of these cyclical stocks, but in right along with them. So stocks like Facebook and Google, it's not terribly an imaginative call, but I do think it'll be profitable.
All right. Chris Grisanti and Robert Teeter, thank you both very much.
Shepard Smith here. Thanks for watching CNBC on YouTube.